Hi there everybody, it's Dale Beaumont here from Business Blueprint and welcome to our latest Business Blueprint webinar. So our special guest presenter tonight, his name is Ed Chan. All right, Ed, over to you.
G'day Dale, g'day listeners, welcome. Tonight will be mainly for small businesses. Let's get on with it. This information I'm talking to you about is of a general nature. You need to get some personal advice to see whether it's applicable to you. Okay, the very first one I thought of was to use a trust as often as you can. Trust is a really flexible structure to use, and there's lots of different types of trusts that you can use. However, the one that's most common to small businesses is a discretionary trust. Sometimes they call it a family trust because mostly families use it. And the reason why it's advantageous is because you can distribute the income to anybody that you decide that's in your family, and so that if someone's on a lower tax bracket, you can distribute more to that person, and obviously if someone's on a higher tax, you can at your discretion not distribute to them. So that's Ed, a very
can I just quickly ask how when is the right time to set up a trust? We've got a number of well-established business owners, so it's probably the right time for them now, but there's a few startups as well. So when is the right time, and roughly how much does it cost?
Yes, it's always best to start it up correctly from the start, because if you try to change something after you've started, it does cost more money. It can be done, but it's just a question of costs, and it will cost you more. So getting the right advice from the beginning, setting it up correctly, would save you a lot of time and frustration. But having said that, you can fix things if you've got it in the wrong entity, but it'll just cost you some money, that's all. But yeah, right at the beginning.
And when with the regards to the trust, basically once you've set the trust up, the company is actually owned by the trust, right? So rather than the shares in your company being in your own personal name, it's your trust that actually in a way owns the company and has the shares. Is that correct?
That's one way to do it. So typically clients will go along to their accountant and they'll say to their accountant, look, I'm going to buy this business, or I'm going to start up a business, and the accountant will generally either set them up in a company and they'll go in as director of that company, and they'll go in also as shareholders. If they were to set you up as a company, it's always best to have the shares in that company held by a trust and not by yourself. And the reason for that is that when that company or that business becomes very, very valuable, then that share that's in your name becomes a very valuable asset. And then typically you'll be a director in your company, and as a director you can get sued. And if your business grew from $0 to $2 million and you held a share, that share is worth $2 million. And if you're a director of your company, then you can technically get sued, and then you've got $2 million accessible to a creditor or someone who's taking action against you. So that's one way that you can set it up. The other way that you can set it up is having the trust own the business outright, and you then have to form a company as a trustee. So a company as a trustee is different to a company who trades on its own. So that's called a trading company, but the company that acts as trustee doesn't trade on its own, it actually trades on behalf of the trust. So the second way that you can do it is you can set up the trust to run the business, and then from that trust you can then distribute income to your family members.
Okay, we know we've got other points, so we can't labour them too long, but the whole benefit of this is that you can distribute income to other parties to potentially lower your income tax, and also it does provide some asset protection as well in the case of, a legal case. Is that they're the two biggest advantages?
Yes, and just very quickly as an example, if you've got some adult children who may be at university, they're entitled, when I say adult, 18 years of age, they're entitled to the $18,200 threshold, income tax threshold, before you pay any tax. So you can actually utilise their tax-free threshold to help you minimise your tax.
And some people saying, if I don't have any kids or my kids are too young, anyone else? Can I rent some kids?
Yes, as long as they're related to you in some way, or they fall within the trustees rules, then you can utilise them as well.
Okay, fantastic. And if they're getting this income distributed, someone's asked the question, do they have to list this income on their tax return? Like, is it actually income to them?
Yes, it is. It is income to them, so they have to declare that income. But as I said, if you're a student and you may be earning a little bit of part-time income, then you've got a threshold of $18,000 you can use up to. And of course, if you're earning a bit more than that, then you can give them sufficient distribution from the trust so that they don't pay more tax than you do. So you can manage your tax liability that way.